Good morning. Welcome to everybody. It is really a pleasure for me to welcome you all here today at this conference on money and monetary institutions after the crisis. Key aspects of the evolution of money and monetary institutions had been identified more than 10 years ago by Curzio Giannini. The sovereign debt crisis in the euro area is a clear example of a situation in which disentangling price and financial stability issues became virtually impossible, and in which the role of the central bank as a guardian of trust was crucial. The unconventional measures adopted by the Governing Council of the European Central Bank were actually aimed at countering distortions in financial markets and self-fulfilling debt runs which threatened the correct transmission of the Eurosystem monetary policy and ultimately its ability to pursue the primary objective of price stability. But the time needed to implement Europe's complex strategy to counter the economic crisis will necessarily be long. In my view, there is no need to question the current objectives of monetary policy. In the case of the Eurosystem, that of preserving medium-term price stability. I do not believe that there is a particular need for financial stability to become an explicit objective of monetary policy on a par with price stability. And indeed, the benefits of our monetary framework have become more, not less evident during the crisis, with inflation expectations remaining so far well anchored throughout. Also, assigning financial stability as an explicit additional objective to monetary policy could risk blurring responsibilities and creating potential conflicts. However, I believe that there is no question that preserving financial stability is a crucial, albeit not exclusive, responsibility of central banks.
There are basically three counter-objections to this view. The first is that the way that monetary policy operates is precisely by boosting credit, by boosting asset prices, and by encouraging risk-taking. So it is hard to believe that monetary policy cannot have an effect in restraining financial imbalances. The second, again, is that we should not forget that even the link that we tend to assume, the link between output gaps and inflation, and the link between monetary policy and even aggregate demand, or particularly output gap and inflation, has actually proved to be quite elusive. It's been very, very hard to pin down its existence with any certainty, largely since the 1990s. But we take it for granted. The third point is that monetary policy, in contrast to regulatory policy, is not subject to regulatory arbitrage. You can think of monetary policy as setting or the basis for the universal price of leverage in a particular currency. As Jeremy Stein recently put it, it basically fills in all the cracks, whereas regulation can only act on the regulated institutions.
I'm not surprised to hear that from central bankers. It maximizes central banks' influence and power over the economy, and actually he's right because central banks have the expertise relative to other players in the economy to do these jobs well. But not everything you can do well, you should do. And therefore, the one thing that central banks lack in this area is the democratic legitimacy to do so. For them to take over these tasks, they will risk being subject to government control and parliamentary scrutiny. That is a high price to pay for taking on such additional tasks. In my view, it's a too high price to pay, since it will impact negatively on the independence which they can pursue independent monetary policy. And let me remind us all that the only area for which central banks are exempt from government control and parliamentary control is the conduct of monetary policy as an instrument and tool. And it doesn't automatically apply to these other tools, and there will be difficult debates in the public if central banks go there. And let me end here and pass the floor on. Thank you.
He makes the point that it's not right now to try and address a balance sheet recession with expansionary monetary policy alone, and that this creates a series of risks and side effects, which he also discussed, so let me not repeat them for brevity, but these are very serious risks. They go from, say, masking balance sheet weakness of banks, reducing incentives to downsize banks and recognize losses, and so on and so forth. So essentially, the paradox is that by monetary policy being set so leniently right now actually creates a lot of risks for the future, including making it more difficult or delaying the resolution phase.
It is not surprising that the use of new and non-standard tools attracts closer attention and sometimes even criticism. How do these considerations apply to the unique case of the euro area? The monetary union is an example of what Curzio called a consortium regime, where monetary sovereignty is permanently transferred to a supranational level. As a consequence, price stability is defined for the euro area as a whole. The challenge for the ECB is to maintain public trust in a multinational environment, in particular when there is significant degree of heterogeneity in economic structures and preferences. Time has been gained for the other actors to contribute their part in crucial policy domains which do not belong to the competence of ECB as defined by its mandate. The European reform agenda has been put on a new footing. It's, let me say that's an important point. The ECB, like all central banks, should not try to do what they cannot do. And one of this is to supplement governments in their structural reform action, or repair broken banking systems. They cannot substitute for lack of capital in the banking system, and so on and so forth. That's probably the first question we should ask ourselves when we decide monetary policy. What can we really deliver within our mandate?
So what I'm trying to say is that we do need to move towards a greater symmetry of adjustment if we're not going to have a deflationary bias. But you can't get that greater symmetry of adjustment by simply pointing at the current account position. Much better to do it by pointing at the risks as resulting from the capital outflows, particularly as mediated through the banking system, and that is a potential way forward so that the macroprudential measures can not only be used within a country for domestic monetary control purposes, but can also be used or attempted to be used as between countries to improve the operation of the international monetary regime.
The impression I have is that to the extent that British prudential management, Bank of England prudential management was successful and led to the propagation of the central banking system, it has to do with the fact that this was all about micro. It was all about micro, not at all about macro. As part of this process, one thing that we tend to forget today is that the counterpart of the put that the central bank was having, was offering the market and by pledging to intervene in periods of crisis, was that there was a reverse put, which the central bank was keeping over the banking system. What I mean by that is that after the fact, after a crisis had taken place, the powers of the central bank in order to restructurate, liquidate banks and so on and so forth were enormous. And I think that one danger of the evolution towards macroprudential rules is that we're forgetting this micro and microeconomic power which used to be with the central bank and which seems to be gradually stripped away from the central bank. So that's something I would really have liked to discuss with Curzio.
If banks are so problematical, and this is my final observation, if we want to think of ways of making the system more stable, should we think of developing the capital market more as a source of intermediation across national frontiers in place of banking systems that can be vulnerable? And could the development of a greater development of the capital market in Europe, in other words, a move to a more American-style system, be a way of compensating for the phenomenon that Charles started out his observations with, the collapse of European bank lending? Thank you.
The centralized system is going to be remaining the safest part of it, and therefore going to have the dilemma of figuring out where to put the boundary lines in the future. Finally, that dilemma of how much to encourage or discourage is going to mean that those fluctuations and those risks are always going to be out there in the peripheral system. And when the failures happen, the demands for bailouts will as well. And so, even if correct ex ante, there's still going to be problems, and inevitably ex post, from any regulations that are decided on. So the one prediction that I can make with confidence is that when the failure does occur, the blame will be spread around, and central bankers will get more than their fair share of it.
So what is the right trade-off between being sure that the banks do not lose appropriate technique for managing their counterparty risk, but on the other hand, we don't penalize the use of infrastructure that we consider being more appropriate? And then, continuing on this line, the next point comes for the central bank. If we are really convinced that the CCP is essential for appropriately managing counterparty risk, and if the model of risk control that is in a CCP is better than whatever model can be developed by banks, so we want that they use the CCP. If we are also convinced that in the current situation there is no way to address completely ex-ante liquidity problem, so there can be liquid and resilient CCP that in some circumstances may not be able to provide adequate liquidity and close the system.
But there is an issue of effectiveness and efficiency. If payment services and systems don't serve well their needs, then we are in trouble. The needs of financial institutions, the needs of end users, then we cannot blame let's say, these people for using alternative systems that might pose new risks. And this has to do also with the collateral discussion that Charlie introduced into this. I'm going to surprise Jeff, that was extremely worried that I would take a long time. I'm known for being not always concise, but I'm going to close here. I am probably, based on the numbers I showed, more popular outside my own country than I am here, but today I can confirm that it's not true, nemo profeta in pater, at least for once. I think Daniel and I are extremely pleased to be representing international organizations today in Rome. Thank you.
But will there be demand for reserves? And I think there will be, because although paying interest on reserves makes reserves and treasury bills much closer substitutes, it does not make them perfect substitutes. Even in today's markets, as we discovered during the crisis, it is not frictionless to convert treasury bills, even treasury bills, into reserves. And the reason for that, I think, is that because treasury bills are information insensitive assets, the market will conclude that the only reason you're selling them in size or trying to borrow against them in size is because you are in distress. That problem does not arise at all if you are simply making transfers of reserves across the central bank's accounts.
This is a mindset that loses focus of what we know, that it's really about making sure you don't monetize large amounts of government debt. In fact, making sure you're not forced to do that. And avoiding being forced into monetizing government debt, as again, I'm not going to put anybody in the spot, but many people in this room have confronted, is an ongoing issue. Sometimes it's very easy, sometimes it's very hard. Central banks have a choice whether they want to play a cooperative or a confrontational strategy. In other words, you can bribe people or you can scare people. If you're not happy about the fiscal policy that your government is pursuing, you can decide to say, please be good, I'm going to cut interest rates, I'm going to provide liquidity, and therefore you won't have to spend as much on fiscal policy. Or you can say, please be good, and until you be good, I'm not going to cut interest rates and I'm not going to provide liquidity, and you're going to have no choice.
In a post-crisis era, how we can secure better coordination between central banks and governments. Our Abenomics, which has been referred to, I think is a case in point. As you know, it consists of 3 arrows, where the first arrow is aggressive monetary easing, the second one is a flexible fiscal policy, and the third one is the structural reforms which enhance longer-run growth. Now, the second arrow, which is flexible fiscal policy, is interpreted as a bent one meaning flexibility, and flexibility means short-term fiscal stimulus and long-term fiscal consolidation. Now, in my view, the key commitment device for this policy coordination is a joint statement issued by the Bank of Japan and the government earlier this year in January, when we adopted the 2% inflation target. This joint statement clarified and made the BOJ and the government to commit to their respective roles along the 3 arrows strategy.
I think we should be a bit worried. There is a risk that these purchases may be prolonged too much and that they become not a complement of fiscal adjustment, not something that facilitates fiscal adjustments as they should be, but something that replaces fiscal adjustment. If this were the case, if these very large purchases were just a way of procrastinating completely fiscal adjustment, even at a gradual pace, I think sooner or later inflation expectations would be derailed.
But perhaps let me simply observe, in a fairly banal way, that the European Banking Union, should it be somehow successful, will result, at least from a historical perspective, in a quantum change in the evolution of central banks. Central banks, Giannini argued, were born and developed with a sovereign liberal state. Nothing in central banking is as dependent, or has been so far, as dependent from states' lawmaking and enforcement as bank regulation and supervision. International cooperation, ever more indispensable with the current market, can only rely upon soft laws. The danger of race to the bottom is looming large. The European Banking Union, which is or will be another effect of the crisis, would break entirely new ground with long-lasting effects on the evolution of central bank or central banking in its relation with multiple layers of heterogeneous sovereign powers.
Central banks are necessarily related to the national state, and if we have a system of independent states, we cannot be unrealistically assuming that we will have a global central bank or something like that. In fact, it was very, in the cooperative system, when he was making proposal, in what direction should we move in the cooperative system, he was very, for instance, very supportive of the Financial Stability Forum, the Financial Stability Board, which is a system of, peer pressure, but that can lead to an ex-ante improvement of the regulation. We have a very delicate balance. Overall, as I said, I think we are moving in an area which is new on many fronts. We have 2 views heard today. One is Claudio Borio, that I think appropriately reminded us of the risk that we are facing. Globalization may be in retreat, signs of growing financial and trade protectionism as states struggle to come to grips with the facto loss of sovereignty. The consensus of the merits of price stability is fraying at the edges, and there can be even a return to segmentation and nationalism. And so we have to be. At the same time, Flandro gave us a better picture by saying, well, after all, every crisis has produced an effort to create a new mechanism of producing trust. So I I hope that Flandro is right to continue and follow the approach, the methodological approach that Giannini proposed. I think this conference wanted to mainly show how this mixture of economic, political, historical, and social analysis can produce a better understanding of the problems we face.